Want to avoid not being able to pay your personal tax bill? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, limited companies and owners of limited companies, so directors, shareholders, in the small business world, how to take money out is an absolute key everyday discussion for us. So in this video, I wanted to talk to you a little bit about how to plan for this dividend tax bill, because it's an interesting one. We've done a bit of a series on dividends. If you stick it in the YouTube channel, you'll see. But one of the things I don't think we've talked enough about is how do you actually deal with the issue of planning for that tax bill, because if you get it wrong, it can really seem like every 2 minutes you're dipping into the business and getting bigger and bigger tax bills. So I want to talk about kind of how to stop that problem. Before I do, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So then, real quick recap on the fact that dividends, let's just presume for now, as we're talking, you've watched the other videos, you know most of the dividends you're taking are going to have a tax bill on them, and they're going to be somewhere between 8 and a bit % at the time of recording and 33 and a bit %, depending on how much you take and at what point of the year and everything else. But it could be pretty significant, and that's personal tax. So the company's going to have paid its corporation tax, and then hopefully what's left, if you've up to what's left in theory, you've taken out in dividends or some of it in dividends, and that second bill is based on how much you've taken. So you might not have to take all of it, you might have only taken some of it, and oddly that's where a lot of the magic is around tax planning, but you'd have taken some money. So, and then in your personal tax return, when you go and declare that, you then get a tax bill for normally the 31st of January, somewhere along the line, depending where we're talking generically, and it can, for some owners, it can seem like a surprise. They're like, wow, okay, where am I going to get that money? Now there's a couple of strategies for this really that people do. The first one is they'll go and they'll say, okay, the company can pay for it. The company's got a lot of cash. I'm just going to take money out to pay my personal tax bill. Now there's nothing wrong with that, but what it goes down as is really further profit or further dividend, further salary to you. And whatever you decide, normally for most owners, it's going to be more dividend. You can end up with paying more dividend tax later on that extra dividend to pay your tax bill. So you're with me on that? You've got, let's say you took 30 grand out and then you've got a big tax bill for the next 31st of January, you've done your tax return, you know what that is. You're like, okay, I need to go and take 5 grand out of my business. That other 5 grand is now an extra 5 grand divvy. So in the next tax year, if you took 30 grand, you've also taken another 5, so you've got 35 grand there to be taxed on next year. And then again, if you've still not done the same thing and you're like, okay, how do I pay now what could be 6 grand tax bill? Oh, I'll nick it from the company again. Now you put another 6 grand on next year's pile, and so on. And it can build up. And a lot of owners just manage that. They make enough money that it doesn't really matter. It's just something to deal with and plan with. And when they look at their business finances, they're aware they have this problem. I'd say though, for a lot of owners, they do get this wrong, particularly if you've not got a accountancy service where you A, working with an accountant, or B, working with one where you get updates regularly enough around that personal tax. It can seem like this massive unknown bill, and you can get in this really weird circular thing where you're doing that, drawing money to pay last year's tax all the time. And if something substantial changes in your business, like let's say you're on a contract and the contract stops, there's no money coming in, you can actually end up in a place where you've drawn and used some of the company's money that wasn't yours, couldn't have been dividend. And I think if you search our channel for directors' loan accounts, you'll have a lot of chat around that, but effectively you end up in a bad position where the company then might have to fork out some tax on your behalf as like a holding tax as part of its corporation tax bill, and it all gets really messy and it can take years to get that money back. It's just a mess. So you really, really want to avoid that stuff. So that is option 1. It's definitely doable. If you've got a very successful business, that might be the way you do it. Now, option 2, and this is more of it's a Pirates of the Caribbean line, and it's more of what we call a guideline than a rule, but effectively you can, a couple of ideas here is you could put off some of the money you draw, treat it a little bit like you would if you were being paid and you hadn't had your tax deducted. So if you're in employment, whatever money you got was yours, but some money's been deducted by your employer and handed over every month. And it's trying to get in that kind of mindset. So if you drew, say, 5 grand out, you might decide, I'm going to put a bit of that 5 grand I drew from the company aside personally in another savings account out the way for my own personal tax bill. Therefore, the company never needs to fork out the money for me. I should have enough. And your question therefore should be, well, how much do I need to put aside? Now, bearing in mind, I said to you that at the time of recording the video, the tax rates are somewhere between 8.75%. Well, somewhere between 0 and upwards to nearly 40% if you're really lucky and take over 125 odd grand. Like, they can get pretty expensive. It's difficult to say exactly, So if you've seen my other videos talking about provisions, this is a provision, so it's not an exact science. If of all the money you drew, if you put 10% aside on the first 50 grand and 30% aside on the next 50 grand, you'll be in a relatively good place. It's not an exact science, because the sharp-eyed view will have instantly thought, well, hold on, you've just told me it's 8% down here and you're telling me to put 10%, and you're telling me it could be 40, nearly 40% over here and you're only telling me to put 30. But for the majority of owners, that should be a really good provision. And what we're not also factoring in here is that the time that you get to pay this money, because if you think about it, if you're in a tax year, you go from April to April when you draw this money, you then get a good 9 odd months then to have to hand over the tax in the tax return. So in theory, if you keep putting money aside, you should always have a bit more. Like, it's a weird thing to do, but if you mapped it out in a spreadsheet, as our SADOs do, that's roughly going to give you a good provision. But please, I'm sure someone will come in the comments and say, yeah, it's never going to be enough. It will be, but it's not an exact science. If you're worried, obviously you could put the exact amounts for you. Put worst case, you could put 39 and a bit% away if you were earning over 125k. And that brings me to kind of option 3. So of 3 strategies, you've got one, nab it from the company when you need it, but that's by far the most dangerous. And I think people really struggle to get their head around that sometimes. The second one is, as we're saying, you're doing this 10-30 provision over your money. The third one is you could literally map it out. You could stick it in a tax calculator online, work out what your personal tax might look like based on the money you intend to draw, and just make sure that you're saving that. You're aiming for that financial goal. So if you took more one month than the next month and put it aside, it wouldn't matter. And sometimes people like that, because it means if you have a really good Christmas or you want to go on holiday and you haven't got any money this month, and you know, it's like cash flow needs at home, it means that you could not put some aside this month and put more the next or something, knowing that it would still be okay. So that's the more accurate way of doing it, is actually do an actual tax calculation, or pay for one if you need one, and just figure out what that's going to look like and plan appropriately. But any of those options tend to work, but the first one is absolutely fraught with danger, because you're relying on the company continuing and you are constantly creating more tax bills. Whereas if you treat it a little bit like you would your PAYE salary, you get your money and you're putting your personal tax aside from the money you've drawn, it's no longer the company's problem. As long as the company could have afforded to pay you all that money in the first place, you shouldn't really be in any problem. So there you go, a couple of thoughts of how you might deal with this one. As I say, few options. I think we tend to find owners tend to sit in the second one quite frequently, but I think if you get into a successful place and you know that your business can afford to pay that money each month, and you know what you're going to be taking, then third option also works very, very well. The first option is great if you're making loads of money and you don't care effectively, but if you're not, I'd try and avoid that one. Please do share this information with anybody that needs to know this. Love hearing from you in the comments, and I'll see you in the next one.